December jobs report boosts treasury yields while wiping out stocks. Indian automakers and 2024 on a very strong footing, and why Lululemon deserves your love. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode, the first episode of 2025 of the Stock Doctor podcast. Oh boy, time does fly. Yeah, it feels like I just recorded the last episode of 2024 just yesterday, and I was like, okay, yeah, I'll see you guys in the new year. Went off for my holiday to be with my family, and before you know it, already time's flown by. And I looked at the clock, and I was like, oh my god, I gotta record the first episode of 2025 already. But having said that, I'm actually really excited to be back. I did miss you guys a lot during the time. I know it was a very long stretch before it was a long stretch before we meet again. But I promise you that I'm really hoping that you guys had an amazing holiday, spent quality time with your families, and you had a really great finish to 2024. And I wish you all the very best for the new year. I hope all your dreams and goals and all of that do come true. Now, and as far as the Stock Doctor is concerned, I do look forward to bringing bigger, more insightful, and hopefully more entertaining episodes for you guys this year, much bigger than at least 2024. The show has grown over the years, and I hope to maintain, if not exceed that growth this year. Right. Lots to chat about, guys. Lots to chat about. Been a entire month has gone by. You'll notice that the one thing I will tell you, I'm going to start off with a little bit of a observation that you guys might come across when you do listen to the show, when you do watch the show, and that is you'll notice that the themes of this week's episode are very similar to the last episode of 2024. I mean, this is pure coincidence, yeah, and it's a consequence of an exact 1 month gap between last episode of 2024, episode 109, and this episode 110. It's just been an exact 1 month gap. It's not like I didn't write the script, or I didn't research on what I wanted to talk to you guys about this month. No, it's just pure coincidence. All right, so let's just get that out of the way now. So all I'm saying is if episode 109 talked about the US jobs report, then episode 110 will also speak about the jobs report. And the only difference, and the similarity ends there. The major difference is last episode of 2024, we discussed the November jobs report. Obviously, this week we will be discussing the December US jobs report, and there's a lot to discuss on that matter, how markets reacted, what the future means for the Fed, and so on. So before I get into the specifics, before I move into the first segment, the Doctor's Weekly Snapshot, let me take you through the market action, the overall market action. It was a trading shortened week, guys, if you recall correctly, and that is because former President Jimmy Carter had passed away. So the stock markets were closed on Thursday, the 9th of Jan. So it was a trading shortened week. We only had 4 trading days. Once the dust settled for the week, all 3 indices actually ended in the red. Not a great start to the year, I'm just saying that. With the Dow down 558 points, S&P 500 down 1.1%, and the tech-heavy NASDAQ down 1.2%. So not exactly a perfect perfect start to the year for the markets. The investors already seem to be a little bit more jittery, not sure exactly whether their holidays didn't go as per plan. I don't know. Anyway, it's not been a great start. So for the first time in 2025, ladies and gentlemen, welcome to the first segment, Doctor's Weekly Snapshot, where I'm just telling you, despite a trading shortened week, there was enough market moving action. And I'm going to start off, obviously, as I discussed earlier, we will be talking about the December jobs report. And one thing I will the other thing I wanted to tell you guys is the fact that the market reaction, especially in the bond markets, it's very strikingly different compared to what we witnessed when the November jobs report was released last month. So, like I said, similar theme, very different results, not so similar results at all. Now, let's get into the numbers first surrounding the December jobs report. Long story short, it was a phenomenal report. Okay, it's fantastic. It just goes to show the December jobs report confirmed that the US economy does remain on a very strong footing indeed, and the labor market there's nothing for the Fed to worry about. There's nothing for investors to worry about any impending recession whatsoever. It's been a cracker of a it's been a it was a cracker of a report. But I wouldn't pop my champagne bottle anytime soon if I were you. More on that in a bit. First, the December jobs report was stellar. Was that the actual December payroll number of 256,000 blew past the economist estimates of 155,000. It basically blew the estimates out of the water. Very simple. Furthermore, the December number even topped the November number of 212,000. So more on, if you want to check out the November jobs report in the US, do tune in to the last episode of 2024, the episode 109 of the show, where I discussed the November November report in detail. 212,000 was the number in November. In December, it was 256,000. So the labor market in the US remains very, very strong. And while in November, the unemployment rate ticked up to 4.2%, December saw that particular rate come straight back down to 4.1%, which was actually below expectations. And this time, below expectations, that actually means it's not exactly, below expectations is actually a good thing, right? Because obviously, if the market was expecting a higher unemployment rate and then you're getting a lower unemployment rate, that's necessarily, again, more evidence that the US labor market remains very, very strong. Average hourly earnings increased 0.3 for the month, in line with the estimates. However, on an annualized basis, the gain was 3.9%, falling short of estimates. The labor force participation rate remained very steady at 62.5%, the same figure as November. Now, you will notice that my voice is a bit hoarse, and that is because I am in very, very chilly London. It is 0 degrees here. So when I came in from a much, much more warmer temperature, straight into a region which is 0 degree. So my voice is a little bit on the downside, okay, just like how the unemployment rate was. Okay, so that's why you notice a little bit of hoarseness in my voice. Apologies for that. I really hope that by next week it is fully recovered. Now, all of this, coming back to the December jobs report, the report simply shows a very, very strong economy. In that note, and now if I were to tell you the economy is very good, what would your reaction be? You would be like, "Oh my God, that's fantastic. There's nothing for us to worry. Let's go buy stocks, right? So you would expect the markets to rejoice, right? Wrong. That's not exactly what happened, and there is a reason why that's not exactly what. There's a reason why the rejoice or the happiness did not transpire. In fact, on the contrary, it was pretty bad. And this is because what the December jobs report, did feed Jerome Powell and co. was enough evidence to keep the rates exactly where they are, and that is elevated. And an elevated rate scenario is definitely not good news for the market. And this is why you did not see any happiness whatsoever among investors. On the contrary, it was pretty bad. It was. It's simply, it was pretty bad. Basically, if I were to tell you, post the jobs report, Dow tumbled nearly 700 points, S&P 500 declined 1.54%, and the tech-heavy Nasdaq declined 1.63%. So it simply means what the December jobs report did was hand Jerome Powell and co. on a platter the news that we don't need to worry about cutting rates anymore. Let's keep rates elevated. And this is because the focus of the Fed will now be on inflation, which remains sticky. Now, this show was on holiday when November's inflation data was out. So let me tell you now that November CPI data in the US came in at 2.7%, an uptick from October's figure of 2.6%. Core CPI rose 3.3% in November, the same as in October. It simply shows that inflation remains really, really sticky. And when you have a sticky inflation, combine that with a strong jobs number, you get a cocktail called strong and sticky. Not a cocktail that the Fed particularly enjoys. In fact, it doesn't like one bit. It doesn't like it one bit. Kind of like my relationship with Negroni. Sorry, Negroni lovers. I just don't know how you guys like that cocktail. I can't stand the sight of it. So it's very similar for the Fed, the strong and sticky cocktail, which is strong jobs report, but sticky inflation, not exactly Fed's favorite one bit. So clearly, the Fed isn't going to party in such a scenario, especially when you have a cocktail that you don't like, which means rates are likely to remain elevated for the foreseeable future. And this is exactly why the 10-year yields spiked to its highest level since late 2023. When you and this is also explains why, as I mentioned earlier, the Dow tumbled nearly 700 points, why the S&P 500 declined 1.54%, and why the tech-heavy Nasdaq declined 1.63%. Because when you have rising treasury yields, as an equities investor, you need to buckle up for turbulence. It simply means that rising yields means a higher discount rate used to discount the future cash flows of the companies, which means lower valuation. So when you have a rising treasury yield, a rising yield environment, it simply doesn't work well for equity valuations. And when it doesn't work well for equity valuations, cue the sell-off, cue the pandemonium. And this phenomenon, this particular phenomenon where rising yields, discounted cash flows become lower, rising to lower valuations, is particularly sensitive for tech-heavy stocks, which tend to be more long-term focused. And this is why you saw the highest decline in Nasdaq. I do have to take a water break here. God, the weather in London has not been kind to me. Anyway, the December jobs report makes the Fed's job a lot easier, to be honest. It shows that the US economy is on a very strong footing. So instead of doing a balancing act between jobs and inflation, worrying about jobs and inflation, it just needs to focus on inflation. And given that inflation remains sticky, it means that it's very unlikely that the Fed is going to cut rates in the January meeting. In fact, if you check the CME Fed Watch tool, then you'll see that the odds of a pause in January stands at 97.3%. 97.3% chance of zero rate cuts. So it's pretty much, you can see, it's one of the highest levels it's been in a long time, and you can clearly see what the jobs report has done to traders, and has the kind of impact that the jobs report has had on traders' outlook for the future when it comes to rate cuts. In fact, once the jobs report was released, traders were even skeptical that the Fed would cut rates in March. The odds of a pause in March, as in no rate cut in March, according to the same CME Fed Watch tool, stands at 74.9%. Insanely high, but not surprising given how fleeting investors can be. I mean, you have a very strong report, labor market great, inflation sticky. It doesn't take a genius to figure out that the odds would be, they're going to be pessimism across the board. Traders are now expecting the next rate cut to come in May, although even the odds of that aren't particularly great. It's about 55.6%. Yes, it's higher than 50, but at a time when 2024 saw investors call for 6 rate cuts at the beginning of 24, you would have expected something more positive when it comes to rate cuts. But clearly, investors right now are not expecting any more rate cuts. And the Fed has already done 100 basis point worth of rate cuts. It did 50 basis in the first, 25 next, another 25 in December. Again, when the show was on holiday. So now the next rate cut, according to traders at least, according to CME Fed Watch tool at least, is it's 55.6%, which is not particularly great. So does that mean that we just sell everything and shut up shop? I mean, like basically no more buying stocks, no more, and just sell it all, sell the portfolio, and just I don't know, go to the Himalayas and relax? No, not particularly. Obviously not, right? That would be a bit ridiculous, to be honest with you. It's very funny how as investors we always say we're going to buy this stock or that stock when it meaningfully corrects. Like how many times have you looked in the mirror and said, you know what, I'm going to buy this stock when it meaningfully corrects. So I'm going to buy this stock when it has a pullback of 20% or anything of those lines. But when the said stock, when your chosen stock does go through a pullback, does go through a correction, does give you the chance to buy, what do? You panic and do nothing. And when I say you, I mean all of us. This is a very the behavioral bias that it's a very it's a behavioral bias that's been extremely prevalent in investors' minds, especially in recent times, especially since COVID. One could say you keep saying stocks can only go up, but when they do correct, we all panic instead of instead of just taking a breather and thinking, is this an opportunity? Let me give you some context. On Friday, the S&P 500's return since election day stood at 0.5%, 10 days before DJT, Donald J. Trump, gets elected. Not gets elected, before he already got elected. It is President-elect Trump. Sorry, guys. It is President-elect Trump. I hope I haven't offended anyone. It is before DJT gets, before the inauguration, Trump's inauguration, presidential inauguration ceremony takes place on 20th. So 10 days before President-elect Trump's inauguration, the S&P 500's return stands at 0.5%. If it holds this way, it would mean that the index is heading for the worst performance between an election and inauguration. How many of you bought stocks during this decline is the first question I got to ask. Pretty much since election day, all those gains have been wiped out. There's been a meaningful correction in the market. Ask yourself, What did I do? Did I panic and sell, or did I panic and do nothing, or did I actually take a breather, take a step back, and actually think, wait, is this an opportunity? Let me give you even more context. From my own portfolio, Oracle is down 19% in the last 1 month for no reason. Excuse me, Nvidia is down 6% for the week, and Netflix is down 8.5% in the last 1 month, despite having a blockbuster NFL games which went through very smoothly, and also WWE programming that also went very smoothly, and still down 8.5% in the last 1 month. How many of you even considered buying these high quality names? I mean, I did. I bought more of Oracle on Friday, just before Friday's close. I did add to my position. It was a very small position. I bumped it up because I feel like 19% in the last 1 month. For no reason, I don't get it. So, and especially given the fact it's been the data center business, the cloud OCI infrastructure business of Oracle is doing very well. So I don't get it. So 19% pullback. I bought more because the sell-off makes no sense in the name. Now, I'm not a registered advisor yet, investment advisor yet, so I'm not telling you to buy these names. I'm not going to tell you to do what to do with your portfolio. It's your portfolio, your money. Do what you got to do with it, right? But I don't want any of you to look in the mirror and curse that you didn't have the guts to purchase the names on your short list when there was a significant pullback. That is exactly what we are getting right now. Pullbacks and corrections are every long-term investor's dream. And after the kind of rally that we saw since election day, a market pullback was long overdue. Treasury yields have essentially gifted investors the scenario. All I will say is that perhaps it is time to fulfill your dreams and buy the names you've been meaning to buy. Next week, we get the December CPI data, and all eyes will be on that. If it's a sticky number, mind you, all I would say is probably be prepared to invest, because when you combine a strong jobs report with a sticky inflation, you get pandemonium. And for long-term investors, as I wrap up this segment, all I'll say is pandemonium is the perfect breeding ground for investment opportunities. On that note, let's move to the next segment. The doctor goes home, where I welcome you, where we head straight from US to India. And again, I'm just going to repeat it. It's pure coincidence that I promise that we end. It's pure coincidence. I promise. It is not. I didn't plan this. It's just so happened that the gap was exactly 1 month. It's pure coincidence that we ended the year discussing the Indian automakers, and we're beginning the year discussing the Indian auto sales. I did not plan this. It simply means, like I said, that an entire month has passed, and it's exactly a 1 month gap. Like I said at the start. Right. Now that's out of the way, let's discuss the Indian automaker. Let's discuss how Indian automakers ended 2024. And all I'll say, put simply, if you really want to put it simply, I can end the segment in one sentence if I have to, if I want to. The Indian automakers ended the year on a massive, massive high. And I'm not saying that lightly. I'm not saying it's not for dramatic effect. It's not for extra likes and follows, all of that. Indian automakers really did end on a very, very strong footing. December sales surged 10 to 12%, coming in between 320,000 and 325,000 units, allowing automakers to end the year at a record high. It also meant that Indian automakers closed out 2024 with a sales at a record 4.3 million vehicles. So it's not exactly, I'm not saying it lightly when I said Indian automakers, boy, did they end on a high. Let's get to the top car makers individually now. India's largest car maker, Maruti Suzuki, had a fantastic month with sales surging 30% in December. 30. That's right. It's not a typo. 30% in December. You heard that right. Coming in at a little under 178,250 units. Exports continued their very strong momentum, coming in at a little over 37,400 units. What was exciting for investors to see is that the segments that were declining bucked the trend and swung upward. I'm talking about the mini and the compact segments of Maruti, which have been going through a very, very steady period of declines. The mini segment actually in December surged a whopping 190% year over year, and the sales growth at the compact segment surged 20% year over year. So they bucked the trend, they bucked the decline, and have they swung the other side in a quite dramatic fashion. Utility vehicles, that can't be surprising. India is now riding the SUV wave. SUVs of Maruti continued their upward trajectory, seeing their sales jump 21% year over year. The only outlier, if I may say so myself, was the mid-size segment. But to be honest, given the month Maruti had 30% increase in sales, I don't think even the company management is crying over that. I mean, I think overall it was a phenomenal month for India's top car maker. The same can't be said of India's second largest car maker, Hyundai Motor. It did not have a great month. In fact, it was probably the only company that was an outlier in an otherwise strong month for PVs. The amount of times I look myself in the mirror and I'm like, boy, oh boy, did I make a mistake in buying Hyundai. I did, this is exactly my reaction when I see Hyundai's numbers, because I think they went the public in the wrong time. Phenomenal company, guys. I still believe in the long-term prospects. I haven't sold my shares, but it's definitely in the sin bin for now. I am definitely monitoring it very, very closely because the volatility in the name is pretty strong as well. So I do believe in the long-term prospects, but the company better, it really buckle up. It better buckle up very soon, at least in 2025. Sales for December for Hyundai declined 1.3%. Even the robust demand for SUVs could not prevent this decline. The only good point is that the company finished 2024 with record volumes at 605,433 units. However, like I said, Hyundai should really watch its back, and this is because Tata Motors actually surpassed Hyundai in terms of sales in December. Tamo sales came in a little over 44,200 units, up 2% year over year. The positive sales growth can be attributed to EVs, which reversed that decline, jumping 11% year over year. As a Tamo shareholder, I am actually very pleased to see that the decline was a one-off. I mean, it was quite a concerning figure in November when the EV sales actually had a pretty bad month. They went on the decline, and I was thinking to myself, "Oh my God!" As the downward trend for Tata Motors started. I mean, I've been a very long-term investor for a while now in Tamo, but it was concerning. So it was very good to see that it was a one-off. As I told you, like I said, I mentioned this in the last episode of 24 as well. My entire bull case on Tamo relies on the EVs maintaining strong market share. While I don't think the company is out of the woods yet, it was at least a relief to see that Tamo ended the year on a strong note, especially its electric vehicles division. Finally, my favorite name on the Indian auto space, Mahindra and Mahindra, just continues to maintain its momentum. I mean, this company is on a it's on steroids, and honestly, it's like it's cruising. It's registered yet another month of double-digit sales growth. More specifically, December sales recorded an 18% growth year over year. Exports were very strong as well, jumping 22% year over year. The company's tractor sales also were very strong. Overall, it's been a phenomenal. It was yet a phenomenal month for the company, and Mahindra, boy oh boy, what a year it has had. And now there's more good news to follow for Mahindra and Mahindra. Have you guys checked out, by the way, the latest EV models, the BE6 and the XEV9E? I mean, boy, do they look sexy. I mean, they would probably give Tesla a run for their money in terms of looks as well. They would probably give some of the Chinese players a run for their money as well. I mean, so the BE6 and XUV9E, they've launched it, they've released the specs and so on. Technical specs looks phenomenal as well. And the company also announced that the BE6 would be priced at 26.9 lakhs and the XEV9E would be priced at 30.5 lakhs. So it's definitely expected to give the competitors a serious run for the money, no pun intended, and I mean both literally and figuratively, because of the simple fact that at 26.9 and 30.5 are very attractive price points, and the technical specifications of those two models are simply, I mean, let me just put it straightforward. They're simply sexy. They're just too sexy. All right. So I definitely, I do expect you guys to check it out for sure. I truly believe that 2025 will be the year for M&M. I think this is their year, guys. I really do. If there is any meaningful pullback, you would expect me to buy more. I'm just telling you out there already. The company has seriously, it had a very strong end to the year, but the growth story of the company is very scary for competitors, at least, that the growth story of the company is barely moved into second gear. It's expected to move into second, third, and fourth, and fifth, perhaps, in 25 and beyond, because once the EV models really take off. Right. Let's move on to two-wheelers now. Hero MotoCorp's bad month continued, or rather bad streak continued, with sales in December declining 17.5% year over year, much worse than November when sales declined 6.5% year over year. For 2024, the company did register a positive growth, but given that the company has ended on a downward decline, it has ended the year on a downward decline, it is not exactly good news for Hero's investors. The only silver lining, if I may say so myself, was that the company's exports were strong, as the 8 new models that it launched helped it expand its presence overseas, especially in Nepal, Brazil, Southeast Asia, and the Philippines. TVS Motor continued its growth trajectory, with sales jumping 8% year over year. EVs dominated the month, with sales surging 79% year over year. The scooter segment also had a phenomenal month for TVS, with sales jumping 30% year over year. TVS exports again maintained their positive momentum, jumping 22% year over year. Royal Enfield had a phenomenal month as well, with sales jumping 25% year over year, primarily driven by exports, which surged 90% year over year. And this is on back of a strong November for exports, where sales actually surged 95% year over year. So it's been a phenomenal. I mean, Royal Enfield also ended a year on a high, and all of Hero's competitors are doing really well. So this is why I said Hero MotoCorp really buckle up. The only company that is not doing well and that is in the same category as Hero is my latest investment, Bajaj Auto. Honestly, I've not had a good ride with some of the auto names in the recent past. At least Bajaj Auto did not have a good month. Sales declined 4% year over year in December, primarily driven by a bad month for domestic sales, where sales actually in domestic market declined 19% year over year. At least the company's exports were good, jumping 15% year over year. I do believe in the long-term prospects of Bajaj. In fact, I believe in the long-term prospects of Bajaj a lot more than what I believe in the long-term prospects of Hyundai. But I haven't sold my shares of any. So if there continues to be if there will be a meaningful pullback, and if there continues to be negative news surrounding Bajaj, I would definitely be adding more to my position. I've got a very small position in my portfolio, definitely looking to add, because I think all this negative news is a buying opportunity, because the long-term story for Bajaj remains intact. Long-term growth story remains intact. Bottom line. What a finish for India's automakers. A truly remarkable finish to the year indeed. And they're entering 2025 with very, very strong momentum. At least most of them are. Hyundai, Hero MotoCorp, and Bajaj Auto will need to buckle up, since their competitors are all moving further and further away. All eyes will now be on the Bharat Mobility Global Expo, which takes place between Jan 17th and Jan 22 of this year. Major players are expected to unveil a diverse range of new vehicles, but in all honesty, 2025 is set to be the year of the EVs, as every single major player is expected to release new EV models. This even includes India's biggest player, Maruti Suzuki, who's been lukewarm, to say the least, when it comes to EVs. They're releasing its first EV model, the e-Vitara. It's expected to be priced at above 15 lakhs. Talk about undercutting competitors. And if the e-Vitara is a hit, then I think Maruti might be late to the party, but it most certainly is going to win the race for sure. I mean, I think if this 15 lakh price point is true, and if the model is a big hit as well. At the Bharat Mobility Global Expo, Maruti announced that at the Bharat Mobility Global Expo, it would be showcasing its E4Me vision, which is expected to highlight the company's plans for its electric vehicles. Hyundai expects to unveil its Creta EV. Current leader Tamo is expected to the likes of Sierra EV, Harrier EV, and even the Safari EV. And then there is my favorite Mahindra & Mahindra, who I'm betting on usurping Tamo as the king of EVs very soon, probably in 2025, most likely it looks like 2025. Indian automakers, let's just say, guys, I'm just going to wrap up the segment by saying Indian automakers ended 2024 on a very strong note. There is absolutely no doubt that 2025 will be an even stronger one. But more importantly, 2025 is really looking like the year when Indian automakers' EV strategies transition into a revolution. Mark your calendars for Jan 17 to Jan 22 to see a glimpse of this revolution. On that note, that's a wrap on the Doctor Goes Home segment, and welcome to the final segment of the show, Doctor Dissects. And the first company that's going to come under the microscope in 2025 is the athleisure giant Lululemon Athletica, ticker Lulu, L-U-L-U. Not talking about Lulu Mall, guys. My Indian fans, Indian listeners. I'm not talking about Lulu Mall. I'm talking about Lulu, L-U-L-U, Lululemon Athletica. Lulu reported its Q3 numbers last month, and it was a very impressive quarterly performance from the company, in my opinion. More specifically, Q3 revenues came in at $2.4 billion, beating analyst estimates by $39.3 million. Diluted EPS came in at about $2.87, up a whopping 46.4% year over year, and beating analyst estimates by 15 cents. Gross margins continued their strong momentum, expanding by 150 basis points or 1.5% to 58.5%. Operating margins also came in strong, jumping 520 basis points or 5.2% to 20.5%. After yet another strong performance, the company once again bumped up its full year guidance above street estimates. The company now sees FY24 revenues to come in between $10.45 billion and $10.49 billion against the previous guidance of a range between $10.38 and $10.48 billion. Analysts were expecting FY24 revenues to come in at about $10.43 billion. The company now expects to see EPS come in between $14.08 and $14.16 against the previous guidance of $13.95 and $14.15, well above the analyst estimates of $14.04. The company also announced that it was raising its share buyback program by yet another $1 billion. The better than expected updated guidance, along with the boost to the share buyback program, resulted in a massive rally post-earnings release. In fact, shares have been doing really well. They ended the year on a strong footing, and they also started the year very strong as well. I think there's a lot of positive momentum in Lulu right now, and there should be, given the performance the company has been delivering. Right, we're not here to talk about just the performance and just the numbers. We're also here to talk about the takeaways. So let's talk about the key takeaways of Lulu's latest quarter. The first, one of the biggest takeaways from Lulu's Q3 report was that growth has returned to the Americas as revenues in the region increased 2% year over year. The return to growth was largely driven by Canada, where revenues increased 9% on a year-over-year basis, and the sales decline in the US has finally stopped, as revenues in the country in the US were actually flat. Now, normally, flat sales are not particularly great, but given the kind of decline that the company has seen in the US amid increasing competition, the fact that it's essentially flat is actually good news, right? It actually is it's very good news. The not so good news is that comparable sales in the Americas continued to be on the decline, with Q3 comps declining 2% year over year. The decline was the same as Q2, which also, it was the same, which is the 2% decline in Q2 as well on a constant dollar basis. So on the one hand, while the decline in comparable sales is worrying, the fact that the rate of decline has actually stabilized and staying the same, when you combine that with a flat revenue in the US and take it all together, it does indicate that some form of stability has returned for the company in its biggest market. Furthermore, the company had a stellar start to the holiday season in the US, which does suggest that things may soon turn to be positive for the company in the region. For instance, during the earnings call, management saw a strong extended Thanksgiving weekend with solid traffic trends across both its brick and mortar as well as its e-commerce channels. The company also had the most visits to its shop app and e-commerce site on Black Friday. What is even more interesting is that the company does not do I repeat, it does not run sales events in any of its stores. I was in the Middle East during the holidays, did pop by to a Lulu store. They did not have any sales. I wanted to check out. There was crowd as well, and they were doing it without any crowd. In the US, without any sale. And in the US as well, the story is no different. They do not run any sales events. So this makes the strong traffic even more impressive, especially at a time when Lulu, in the US at least, is operating in a very, very highly competitive landscape. Finally, within the same takeaway, after the self-inflicted setbacks in the first quarter of FY24, when the company messed up the product assortments, thereby failing to capitalize on the demand in the US, Lulu has actually quickly moved to rectify these errors. So that was also very positive to see as well. The company has a long way to go, don't get me wrong, before investors can be comfortable with the company's US performance. It may have 24 million members in the US alone, but as long as comps are on the decline, there will always be question marks. Having said that, there is definitely a sense of urgency among Lulu's management to ensure that the company gets back on track in its biggest market. And the fact that the company does not have to resort to discounts during the holiday season, despite the increasing competitive environment, it's a very positive sign indeed. And it demonstrates that the company does have the ability to turn things around in the US through innovation. The company did lose its way in the US towards the end of FY23 due to its own missteps. And while the US continues to be a show me story, evidence from Q3 shows at least the company does appear to have course corrected. That's the first major takeaway. Next, it's all about the company's international markets. As the company works towards stabilizing the US market, the company's international markets have been firing on all cylinders. Q3 was no different, and the growth in comparable sales in the international markets actually helped the company to post a positive growth overall in comp sales on a year-over-year basis, helping the company buck the trend of 3 consecutive quarters of slowing sales. More specifically, international net revenue jumped 30% year over year on a constant dollar basis, and international comp sales jumped 22% on a constant dollar basis, more than offsetting the decline in comparable sales in the Americas. China was once again the star for Lulu as sales jumped 37% year over year. The company's strategy of aligning their brand in line with the government's Healthy China 2030 initiative appears to have paid off handsomely. The company also undertook several activation events in the region during the quarter, including its largest event in the region, which centered around World Mental Health Day. More than 15,000 guests participated in this particular event, and the company generated 3.8 billion impressions. This is simply another example, another wonderful example of the company's unique marketing strategy in China, one that has been rewarding the company and its shareholders with strong double-digit growth for the past several quarters. The company has also been making making several moves outside China as well, as it aims to grab a foothold of the APAC and the EMEA markets. For instance, the company plans to open new stores in Italy next year, as well as also venture into the likes of Denmark, Belgium, Turkey, and the Czech Republic in 2025. The international markets have been a blessing for the company, especially with in the US ramping up, especially with competition in the US ramping up in recent months. Q3 was no different, and the growth in the international markets is the primary driver of the stellar quarterly performance. The good news is that the company is not resting on its laurels and is continuing to leverage its popularity to build a very strong base internationally. Of course, it will take time for the company to get back to strong growth in the Americas. In the meantime, if there's one thing we have learned from Q3, it is that the company can always rely on its international markets to offset any headwinds in the Americas. Now, about to take my book and my pen. That can only mean one thing: valuation. So, Lululemon valuation. Let's start, right? As I mentioned earlier, the company now expects FY24 EPS to come in between 14.8 and 14.16. Okay, so projected EPS, according to management, is 14.08 and 14.16, and this is against their previous guidance of 13.95 and 14.15. Analysts were estimating EPS to come in at $14.04. So analysts were estimating EPS to come in at 14.4. According to LSEG data, the company in the last 5 years has on average beaten the mean analyst estimates by 1.66%. So 1 plus point, not 166. So it has beaten the analyst estimates by 1.66% on average in the last 5 years. Assuming the company beats the consensus estimate by this margin, then FY24 EPS would come in at 14.27. Okay, which is a very reasonable estimate in my opinion, given that the company has had a very strong start to the holiday season and has not relied on any discounts to boost demand. As such, I'm assuming FY24 EPS to come in at 14.27, slightly below my previous estimate of $14.37. So analyst estimates was 14.04. 1.66% is the average beat of analyst estimates in the company in the last 5 years. So if you do that, if it beats this by the same margin, then FY24 EPS would be 14.27, and that's exactly what I have estimated. Assume for my calculations. The company, according to LSEG data, currently trades at a forward price to earnings of 26.6, in line with some of its peers such as Nike and VF Corp, but below such others as Under Armour. The company also trades well below its historical levels. For instance, the 2-year historical forward PE median multiple is 28.2, 5-year median multiple is 33.9, 10-year historical median multiple is 30.9. In my opinion, the stock has definitely undergone a re-rating on the downside because of the slowdown it experienced in the US. And while the situation in the US has stabilized, the company still has not completely, it's still not out of the woods yet. However, as mentioned earlier, things are most certainly improving. Factoring all of this, I have assumed a forward PE multiple of 28.2, which is the company's 2-year historical median. So 28.2x is what I have assumed. 28.2x is my value, is my estimate for the calculation. The estimate is below my previous assumption of 31, and this is simply a result of the re-rating of the stock. According to Seeking Alpha, the company's forward PEG ratio, price to earnings to growth ratio, stands at 2.32, in line with its 5-year average of 2.34, but well above the sector median of 1.67. If I assume the ratio to be 2.32 for my calculations, then at a forward price to earnings of 28.2, the projected FY25 EPS growth would come in at 12.15%, which is slightly above its long-term average growth of 8.83%. However, this 12.1% earnings growth is a reasonable estimate, in my opinion, given that the demand seems to be coming back for the company after the initial setback at the start of FY24. As such, I've assumed a growth rate of 12.1, and that would mean projected FY25 EPS stands at $16. It's slightly below my previous estimate of $16.88. So it's about $1 below, 88 cents below. So $16 is my projected FY25 EPS. So you take 28.2, you multiply that by 16, and what you get is an updated price target of 451. This would be well below my previous target of 524, but it still represents an upside of about 14% from current levels. So you still there's an upside. So 451 is my price target, 14% upside from Friday's close. And the difference between my price targets is simply due to the re-rating of the stock. All right, it's as simple as that. But given that there is still decent upside from current levels, while I am downgrading my rating on the stock from strong buy to buy, it is still a buy. Okay, all I'm saying is I'm downgrading my stock but maintaining the rating at buy. So I would still say that there is enough upside for investors to definitely dip their toes in and start a position. Probably existing investors may have to wait a bit for a pullback, but if you're new investors, definitely worth considering taking a position, small position at least in the name, at least based on, that's my opinion. Okay, this is not investment advice, so I'm going to put the disclaimer out there. And the other disclaimer is I do own shares of Lulu. I have been a long-term investor of Lulu for a while, gone through the ups and downs, but I do think that the company is doing really well. Now, every bull case has risk factors, right? I always mention this in the show. If there's a bull case, then there's definitely risk factors. The risk factor when it comes to Lulu is that the US situation is the biggest risk factor. The slowdown has stabilized, but the company, like I said, multiple times is still not out of the woods. The other risk factor also remains the same last time I discussed Lulu, which is increasing competition. As I mentioned the last time I talked about Lulu, Alo and Vuori have started to provide increasing competition to Lulu, and the two of them have even started to attract celebrities like Taylor Swift, who were in the past fans of Lulu activewear. In addition to these companies, Lulu more recently has also been facing competition from Athletica, which is the athleisure segment of Gap. Athletica actually returned to growth this year, and so the landscape essentially has become even more competitive compared to last time I talked about Lulu, and how Lulu navigates this environment is very, very crucial to my bull case. Bottom line, it was a very strong quarterly performance from Lulu, with both the top and bottom lines beating analyst estimates. The company's gross margins also came in really strong, allaying any fears of a slowdown in profitability. The strong Q3 performance led the management to raise their full year guidance, with the updated guidance also topping analyst estimates. While the company continues to see declining comparable sales in the Americas, the declines have indeed stabilized to an extent, and the company expects its seasonal newness to help it grow back to growth in the region. The holiday season has been very strong for the company, despite not having any sort of discount sales and offers and so on. In the meantime, while the company gets back to the growth in the Americas slowly, the international markets have been firing on all cylinders. China in particular has been a very standout performer for the company, registering yet another quarter of double-digit sales growth thanks to the company's unique marketing strategy involving local activation events. There was a lot of negativity surrounding Lulu at the start of the year, with analysts and investors both questioning whether the company's growth days are over. While the start to the year was bad and was self-inflicted, the company, in my opinion, has already course-corrected and looks set to end the year with a bang. More importantly, the future looks even brighter for long-term investors, and that should be the key takeaway from Lulu's latest quarterly performance. That's all the time I have for you this week. Oh my God, the first episode of 25 is done. Really excited, guys, to be back again. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. Like I said, Happy New Year. I wish nothing but the best for you, all of you in 2025. May all your dreams, wishes, all of that come true. And in addition to all of that, I really hope you make more money in 25 than you did in 2024. So I will see you next week. Until then, stay safe and make some money.